Harbour Energy has delivered a message of caution to the market. The company, a major North Sea player, announced a 2026 production forecast lower than expected. Harbour projects 435,000 to 455,000 barrels per day, a step down from recent years. The January 22nd announcement forced investors to reconsider Harbour's short-term growth. The forecast excludes planned asset sales and the $3.2 billion LLOG acquisition. After a strong year, the contrast with 2026's outlook is stark. The market's attention is now fixed on how Harbour will navigate this new reality. To understand the concern over 2026, we need to look back at 2025, a banner year for Harbour Energy. The company delivered exceptional results, hitting 474,000 barrels per day, the top end of its guidance. This was an 84% increase over the previous year, driven by new wells and successful project execution. Harbour also excelled at cost control, with unit operating costs averaging just $13 per barrel, a 20% reduction. Strategic integration of Wintershall DEA assets and disciplined spending were key. Despite headwinds like foreign exchange shifts and the Vietnam divestment, Harbour navigated challenges effectively. CEO Linda Cook highlighted 2025 as a year of strong delivery and capital discipline. The company generated stronger than expected free cash flow, even as global commodity prices softened. This performance set high expectations for continued growth. Investors saw Harbour as a company capable of integrating acquisitions, controlling costs, and maximizing output. That's why the 2026 forecast was so jarring. The narrative shifted abruptly from rapid growth to moderation and repositioning. The contrast between 2025's triumph and 2026's caution is stark. Investors are now grappling with a new reality. The market's unease is rooted in this dramatic shift in outlook. Harbour's challenge is to prove it can sustain value in a changing environment. The company's next moves will be closely watched. The market reacted swiftly to Harbour Energy's announcement. Shares dropped about 2% by mid-morning in London, a clear sign of investor disappointment. The optimism built in 2025 was punctured by the lower 2026 production forecast. For oil and gas producers, production volume is a key indicator of future earnings. Harbour's signal of lower output raised red flags about future revenue and growth. The sell-off reflected a classic market response to revised expectations. Investors who bought into the growth story now faced a period of contraction. Some chose to exit, putting further pressure on the stock. The market's reaction underscores the importance of forward-looking statements. Past performance matters less than future prospects. The 2026 forecast became the focal point for traders, overshadowing past successes. This episode highlights a core investing principle. What matters most is where a company is headed. For Harbour, the new direction was seen as a step back. The company must now work to rebuild confidence. The share price drop is just the surface. The real concern is the uncertainty created by the new forecast. Excluding asset sales and the LLOG acquisition leaves investors guessing about Harbour's true core health. A decline in core production raises questions. Are fields maturing too fast? Is there a lack of new projects? Is UK investment being cut too deeply? The shift from aggressive growth to consolidation is a major strategic change. Investors attracted by high growth may now question the company's evolving character. The fear. Harbour is entering a period of lower growth and profitability. The stellar 2025 results might now look like a peak, not a new normal. With softer commodity prices and a lower outlook, investors are recalibrating their expectations. The uncertainty is driving market jitters. Harbour Energy isn't simply letting production decline, it's making a deliberate strategic pivot. The company is reshaping its portfolio, selling some assets and pursuing major acquisitions. A key move. Reducing investment in the UK, reflecting a shift in regional priorities. Harbour is now focusing on capital discipline and cost control, targeting only the most promising opportunities. The strategy is a response to both internal pressures, like maturing fields, and external ones, such as market volatility and UK regulation. By selling assets, Harbour raises cash and streamlines operations. By acquiring new ones, it diversifies and adds reserves. The company is moving from maximizing volume to maximizing value. Every investment is scrutinized for return, not just output. This pivot is a calculated risk, betting that a leaner, more international portfolio will deliver better long-term results. The emphasis is on resilience and sustainability, not just growth. Harbour's future will be shaped by how well it executes this new strategy. The market is watching to see if this bold shift pays off. Harbour's transformation centres on selling some assets while buying others, a common industry practice called portfolio high grading. By divesting underperforming assets, Harbour unlocks capital for debt reduction, shareholder returns, or reinvestment. The $3.2 billion Analyst acquisition in the Gulf of Mexico is about more than just adding barrels. It diversifies Harbour's footprint and brings high-quality assets. Acquisitions can reshape production and growth prospects, but carry integration and valuation risks. Divestments, like the Vietnam sale, simplify operations and focus resources on core strengths. This cycle of divestment and acquisition aims to build a more valuable, resilient company. The lower 2026 forecast reflects a transition, production lost from divestments before new acquisitions ramp up. Investors are being asked to trust that this churn will ultimately strengthen Harbour Energy. Capital discipline is now Harbour Energy's central theme. The company's 2026 capital expenditure, including decommissioning, is set at $1.7–1.9 billion, reflecting reduced UK investment and stricter project selection. This focus is a response to commodity price volatility and the need for financial stability. By scrutinising every investment, Harbour aims to maximise returns and protect profitability. The goal value over volume. A smaller, more profitable company is better than a larger, less efficient one. The 20% cost reduction in 2025 shows this isn't just talk. For 2026, capital is being channeled to the highest return projects. Harbour's new mantra, spend less, but spend smarter. Free cash flow is a key metric for Harbour Energy. In 2025, Harbour generated $1.1 billion in free cash flow, outperforming expectations through high output and cost control. This financial strength allowed flexibility for debt reduction, shareholder rewards, and growth. For 2026, the forecast drops to about $0.6 billion, based on lower production and ongoing investment. This 45% decline is a direct result of the transition period. The high cash flow of 2025 came from maximizing existing assets. 2026's lower figure reflects heavy investment and reshaping. The big question: can the new portfolio eventually match or exceed past cash flow? For now, Harbour faces a leaner year ahead. Harbour Energy stands at a pivotal moment, prioritizing value and resilience over volume. The lower 2026 forecast reflects a transition, marked by asset sales, acquisitions, and reduced UK investment. Success depends on executing these changes and integrating new assets like Analyst. The external environment, especially commodity prices, remains a wild card. Harbour is asking investors for patience, trading short-term growth for long-term value. The journey involves tough choices and bold moves. The market will scrutinise every step. The real test will come in 2027 and beyond, as Harbour's new strategy is put to the test.